What's good, YouTube? Welcome back to my video. Today I'm going to be talking to you guys about the top 10 reasons why traders fail or why they succeed. So I'm going to be giving you guys an update on the small accounts challenge. So this is the episode number 2. Now, so before we get started, if you could please leave a like and subscribe. So to get started, the number one reason why people lose money is because they do not have a strategy or they do not stick by it. So I'm going to give you guys two common strategies. If you guys want to take a screenshot of this, you can. So the first strategy is that a lot of traders do is they buy on breakouts. So when a stock breaks out, they'll go ahead and buy and ride the wave of the breakout. So example, on a falling wedge, it'll hit a couple times right here, and then when it starts getting ready to break out and it leaves that triangle, then they'll buy and ride the wave and set a stop loss in case it decides to reverse. And these are different types. So the more common ones are falling wedge, bullish rectangle, a pennant's pretty common, and then double bottom and head and shoulders or inverse head and shoulders. So these are just a lot of the common ones. The other one is buying on supports and selling on resistance levels. So example, you guys got to learn when you trade to find a support level and a resistance level by basically drawing a line on areas where stock will typically bounce off of, whether it's upwards or downwards. So you would buy right here at the support level, you would ride it all the way up until it hits that resistance and sell out. Example right here, if you were to buy right here, as soon as it breaks that support level, maybe set a stop loss just under that support level and then sell out at a small loss. So if it goes all the way down, you don't lose all that money and you're not stuck with a stock and have dead money. So then if it goes back up to that support level, you'll buy back at the support level, ride the wave to the resistance, and you just keep repeating this with different stocks, and you will always have an opportunity. You just have to look through the market and find the correct stock that works for you. So number 2 would be position sizing. You got to know how to position size. So you shouldn't be going all in at once with a single stock or two stocks. What we should do is possibly go ahead and divide it. But what I do is I divide it by 6. So example, let's say I have $5,000 that I'm trading with. So what I would do is I would take 5,000 divided by 6. I would not purchase more than $833 for every position I would go in. So if I'm looking to buy a stock, I wouldn't purchase more than $833. If you have $25,000, divide that by 6. 4,166 is the most that I would purchase. I would try to purchase everything around the same price. So you should position size the same amount each and every single time. If you don't want to follow that rule, I would probably suggest not to go over 20% of your portfolio in one single stock, just in order to mitigate your risk. So number 3 would be not doing your DD. So the DD stands for due diligence. So you gotta research the companies, you gotta look into the companies, you gotta understand everything before you buy the stock. So if you don't understand the stock, this works for traders and even long-term investors. So example, let's say you bought a stock at $100 and it starts going down to $75. Now you're panicking. But if you did your due diligence, you would have known that tomorrow there's a conference, and then in 3 days from now they're releasing a partnership, and there's a whole bunch of catalysts that's coming up, but it's coming up in a week time, or the president's going to be talking about the department. If you're purchasing an EV company, they're going to be talking about EVs. They have a plan going out for EVs. So you got to know all this stuff, what's going on through the company and in a macro level. Because if you understand this info, you wouldn't be selling out at $75 because you know that this next upcoming week could take the stock up to $150 if all the news turns out to be good as expected. So that's just an example of why you need to do your DD. It's basically a way to make sure that you're not panic selling or psychology isn't going against you. So number 4 is risk versus reward. And I said it's a risk versus reward, not reward versus risk. So risk is always ahead. You got to know what you're risking before you purchase any stocks or for trading. So example, Right here is a position I'm looking to, well, I just got in at $3 yesterday. I put a small position size. I'm probably gonna maybe dip by a little bit once it hits that support level. But Mustang Bio Inc. at $3, I looked at it and I saw this is a support, so I put a little bit under that support at 274. So I know I'm risking about 26 cents. So in order for me to buy this, I would like to typically have 3 risk to reward. So I would do 26 times 3, and that's where I would need to cash out. And if it matches a resistance level, or it matches where the past it has hit and bounced back, then that's a good sign. What I did is I did 3 different targets. I did a 2.5 target, so I'd aim for this resistance. I would aim just right here where it has hit in the past, which looks like to be not a strong support / resistance, but it's still there. And then I targeted the main resistance. So what I would do is look at the risk and reward. If the risk and reward isn't there, it's not at least 3 or more, I wouldn't take it. And the reason for that being is because let's say you have a 3 risk to reward, you only need to be right 1 out of 3 times in order to break even. So if you're right even half the time, you're going to be a profitable trader. If you're right 40% of the time, you're a profitable trader. As long as you're right more than 33% of the time, then you're good. If you're doing a 5 to risk ratio, then you literally only got to be right 2 out of 10 times to break even. So that's basically what it is. Now, number 5 is position entry. You got to learn how to draw your support and resistance lines, and basically not enter in the middle of a support or in the middle of a resistance. So as an example, if you're to purchase right here, the stock would go down because you're purchasing in the middle. When you purchase in the middle, it's a 50-50. 50% chance it goes up, 50% chance it goes down. If you purchase in the middle and the stock goes down, you might end up panic selling, but for what you know, there's a support right there, so it's actually due time for it to go back up. So if you're purchasing in the middle, there's now a higher risk versus the reward. So it's not worth entering in the middle, but it's better entering near the support areas. So that's pretty much it. So if we were to do this stock example right here, if you were to purchase right here, or even right here, anywhere in this area, you're not purchasing near support. So there's more downside than there is upside. Where if you're purchasing where I'm purchasing right now, there's a support. If the stock goes down, oh well, I lost 26 cents. But if the stock goes up, now I'm making $1.50 and much more depending on where I sell out. So number 6 is do not chase stocks. Chasing stocks is never good. An example, Wall Street bet stocks, etc. If you want to get in, by all means you can. I know a lot of people have made money through it. People are probably still going to keep making money through it. But keep in mind more of the pump and dumps. So a lot of the times you're going to see stocks that are $1, $2, etc. Sometimes even more, but they go up 900%. And when you look into why they gone up and you do some research, you're going to find there's no reason why they went up. They literally went up because it's basically being pumped and dumped. I'll give you guys an example of where you could take an advantage of it. So I wouldn't buy when it's already gone up that much, but here's an example. So on February 16th, I tweeted out that I'm going to go ahead and buy dogs. And the reason why I was buying dogs is because their competitor Pets went up like 320% on zero news, and dogs was up like 12% on zero news, and this is all after hours. So I purchased after hours and basically went ahead, and when I woke up, the stock was up like 70%, and I set a stop loss, and as the stock price kept going up, I kept increasing my stop loss. Then it hit my stop loss and I made 87%. So it sold for me because it started going down, and I made 87.72% on dogs. Basically because Pets was being pumped and dumped, so I figured that they would do the same thing with dogs. Looking at it, that it was only 10%. It was lagging behind Pets. And I went ahead and sold, and I think I sold like at $4 on that stock, or like $3.98 or something like that. And if you can see right now, look at the price. This was a clear pump and dump. I don't think it's going to hit that price anytime soon. It could possibly, but that transaction was literally just a pump and dump. So avoid being one of those that buy here, etc. If it's gone up too much, maybe try to find competitors or certain stocks that maybe pumped and dumped late next, and you could probably get in. So number 7, not keeping enough cash or being overextended. So this one killed me, and it will definitely, the markets will definitely humble you. So I bought a bunch of stocks, and I ended up buying like 20 plus different stocks in my portfolio in the small challenge account, and I overextended myself. I was being too greedy. I wasn't following my regular rules that I always follow, and when the markets went ahead and dipped, I had no cash to go ahead and dip buy. I had no cash to buy deals that were out there in the market. And with that being said, I lost a lot of money and I lost a lot of my gains. And that kind of screwed me up because I was overextended, and this happens to every single trader. As long as going forward you could learn from your mistakes, that's all good. So number 8 and number 9, I put these together, and this is being too greedy or being too attached. So example, let's say you bought right here and the stock ran up. You bought at like $3. It literally went up to doubled your money. Start taking some profits. Start scaling out along the way. Don't be too greedy, or set stop losses. Set stop losses here somewhere, so when it goes down, it sells up and you don't lose all your gains. So if you bought right here and you got too greedy because you thought that the market was going to keep going up, you would find yourself right now breaking even, and who knows, maybe in a week or two you'd be at a loss. So make sure you're not too greedy. And number 9, don't get too attached. So if you see a stock go down, so example, if you see the stock you bought right here and you see the stock go down, don't get too greedy, don't get too attached. Sell, take your small loss. It's better to take a small loss than to hold on to dead money into your account for months or maybe like even years. I know a lot of people do that. Now, in regards to trading, it's literally 10% strategy, 30% position sizing, and 60% psychology. And the reason why I say take your small losses is because look, if you lose 5%, it only takes 5.3% to make your money back. 10%, 11.1, so on and so forth. Now look, 40% loss, you got to make 66%, 50%, 100% gain in order to make back your money. And as you can see, if you lose 90% of your money, you need to make a 900% gainer in order to break even. So that's why it's good to take your small losses and let your wins ride, but don't get too greedy and set your stop losses and keep bringing up your stop losses. So number 10, this is really a tip. I would say separate your accounts or journal your trades. So example, I would have an account for swing trading with your charts, have an account for fun money if you have extra money in case you want to YOLO, because you don't want to start YOLOing money or buying stupid stocks for fun on your swing trade account or on your long-term account, because it's going to affect your portfolio. So you would want to have that, and then you want to have an account for long-term trades. And the reason why I say this is because a lot of the times psychologically people are going to have swing trades, and they're going to go ahead and turn those swings into long-term trades and be like, oh yeah, the company's really good, but your intentions at the start wasn't to long-term trade it. So it's essential to put it in your like 401k or RSPs if you're in Canada, and have those trades for long-term and then other trades for swing trades. Don't mix things up, because then it gets complicated and you'll lose more money. Now, in regards to the small accounts challenge, at one point I was up over like 35%, and the market literally humbled me, dropped me down to 9.9, so 10% gain, and I didn't have my stop losses in place. I was all over the place. The market humbled me because I made a lot of money in such a short period of time. In like 10 days, made 30%, kind of got too greedy with it, wasn't following my rules, and now I'm down 9.6%. So I lost all my profits and a little bit more than just my profits. But that's pretty much it. That's pretty much it for this episode. If you guys want to follow me on Finance, I just went ahead and dropped some new stocks that I'm purchasing and where my take profits and stop losses are. So if you guys want to tag along, you can. Please leave a like and subscribe, and peace out.